It's Friday, August 25th, 2023, episode 220. I'm Kevin Muir. My co-host Patrick Seresna is away this week, so this will be an interview-only show. But don't worry, regular scheduled programming will resume in September. But for now, please enjoy this interview with Aahan Menon from Prometheus Research. We dig into their macro framework, their definition of liquidity, and why Aahan believes the bond market is still not finished declining. It's our great pleasure to welcome to the show Aahan Menon. He is the founder of Prometheus Research. Aahan, thanks for coming.
Kevin, great to be on. Thanks for having me.
So your Prometheus Research is probably a name that not everyone's going to be familiar with. Why don't you tell us a little bit about what you guys do and who you are?
Yeah, for sure. So Prometheus is a systematic macro research firm dedicated to the democratization of finance. And what we do at Prometheus that's pretty unique relative to what you'll see in the general macro universe is we spend a lot of time trying to develop a really granular and comprehensive understanding of the macroeconomic conditions. And we take that understanding and systematize it to create proprietary investment strategies. Now, we offer a range of written research, ranging from, short kind of one-pager trading signals to long 50-page in-depth discussions on what's happening with the macroeconomy, along with consulting services and things like that. And so, we try to cover investor needs as broadly as we possibly can. A quick note on myself. I have a background from both the institutional buy side and the retail sell side. I started my career on the research team at a global macro hedge fund called Lightsky Macro. And then I continued that research career in a pretty different setting at a brokerage called FXDD. Taking the experiences from there together, we started Prometheus about a year ago. Back then, it was just me. Since then, we've added an analyst and, we're looking to grow further. It's been a pretty great time to do what we do. And what we really specialize in is kind of managing the balance between comprehensiveness and granularity in macro. And I'm excited to share some of that with you today.
What was the impetus of going off on your own? Because this is something you've always wanted to do?
I think, just been entrepreneurial from the get-go. I always believed that I wanted to do something for myself. And I think I've inherently always just been a more creative person and looking to make something new.
When you look at the macro environment, do you think that there's a lot of kind of stuff out there that doesn't seem quite right and that you want to explain to people? Like, I know I'm frustrated by some of the things that I see in terms of just takes that are, seem to be more, trying to conjure up images of doom as opposed to actually explaining to people what's going on in the macro environment. Do you feel the same way?
Yeah, I think that it's generally true that what gets clicks on the internet is doom and gloom as opposed to level-headed, balanced kind of systematic research. And I think that's just, it's much more entertaining to read about how the financial system is going to collapse tomorrow, right? But I think that most people that are managing risk and managing, any kind of portfolio exposure in markets, they need something that's just level-headed and maybe a little less exciting.
Yeah, I hear you. That is exactly what a lot of us need, because too often those, or almost always those doom kind of sayers, they end up being completely wrong and you just end up costing you money. So why don't you talk to us about what you see in the environment now? So let's just go through in terms of what your research is sharing with people. Let's just start with growth. You think that we're entering into an economic slowdown and that it will eventually turn into a recession. I'd love to hear your thoughts about why you think that.
For sure. And so I think the major thing is that, yeah, we do think we're in a slowdown. And it's so far just been a deceleration, but a very resilient kind of slowdown, right? And I think the main thing that we have been kind of working through is the fact that this slowdown can be quite protracted. And so the destination that, people seem very certain about is that we'll eventually be at a recession. And I think that is largely a consensus view. I think that the thing that is not such a consensus view is that it can be a protracted path to getting there. And so I think to take a step back for a second, we need to think about why a lot of people expect a recession. I think,
okay.
I think the typical path to a recession is as follows. You have, and this is just a cycle archetype, which everyone kind of uses as a playbook. So you start with interest rate hikes in response to inflationary pressures. We had COVID, stimulus, very high inflationary pressures. And as a result, the Fed kind of embarked on one of the fastest and, most severe tightening cycles on record. And what that tightening cycle is supposed to do is it's supposed to tighten financial conditions, and it's also supposed to raise interest burdens or debt service costs relative to nominal income. Over time, that is supposed to result in a squeeze on profits, and that squeeze on profits elicits unemployment in the form of, layoffs, right? And so when we have those layoffs, that's kind of the nonlinear event where you precipitate a recession. And so where we've been so far is that we've had the hikes, we've had slowing nominal GDP, though not crashing nominal GDP. And interest rate costs have been kind of flat-ish. And we just haven't got to the point where profits have been so bad where we can have layoffs. And so when we're thinking through why that's going to happen, we think that why this is going to be a slow process and why it hasn't been as fast as a lot of people expected coming into this year, we see four major reasons. And those four reasons, two of which are structural and then two of which are pretty particular to this cycle. So what are those reasons, right? The first two, which are structural reasons, is basically over the last few decades, what we've had is a recomposition of private sector balance sheets. And what that is really is post-financial crisis and starting as early as the 2000s, you basically had a growing government sector and also growing short-term liquid assets. And what that's basically done post-GFC, where you had a massive deleveraging of the private sector, is that you basically had a recomposition of private sector balance sheets, where they have more cash and cash-like assets relative to long-duration debt. And what that's done is it's actually made the private sector a net beneficiary of tightening. And so I think the easiest way to think about this is everyone thinks about how a bank has to pay short-term interest rates and then go lend it long. Essentially, the consumer and corporates have the inverse of that. And so the initial stages of tightening have actually been a net benefit to holders of cash or cash-like assets. And what that has done is that even as your debt service costs have risen, you've had your net interest expense about flat because you've got the benefit of this interest rate on your cash-like assets. And so when you look at that interest burden that has typically risen in the past, it just hasn't moved. And so you don't have a squeezing of incomes just yet from the tightening cycle. And so that's the financial part. The second part that's structural is that what used to typically lead us into recessions has been leverage sensitive sectors. And the two that really stand out are the manufacturing sector and the residential sector. Now, I think the major change that we've seen is that over the decades, manufacturing has become a smaller and smaller part of the economy. And manufacturing was generally a very good barometer of what's happening with cyclical conditions because as interest rates would rise, manufacturing, which is extremely leverage sensitive, would respond very poorly because investment would slow, this interest rate burden would rise and it would be tougher to invest in new projects and create new manufacturing capacity. And so manufacturing would begin to soften ahead of the rest of the economy. And it would soften enough eventually to bring down the whole economy. But what we've had over decades is we've actually had a recomposition of the economy to move away from manufacturing and more towards services. And so as a result, the amount manufacturing has to deteriorate now to cause a meaningful kind of impact on the total economic pie is quite sizable. And so when we put these two kind of restructurings, both in terms of balance sheets and in terms of manufacturing versus services together, you basically have an economy which is way more resilient to interest rate hikes relative to any cycle we've seen in the past.
Okay. And so those are the structural things. And then there's two other ones that you mentioned.
And then there are two other subsets, right? And these are very much more cycle specific. So, I think that it's important to recognize that you can kind of look at these structural things and expect them to be marginal changes, right? Or you can expect them to be drivers over every cycle in the future as well. But then there are some things that are specific to this cycle. And so what are those things? The first thing is that we've had a massive, due to onshoring and due to supply chain disruptions and things like that, we've had a massive semiconductor shortage. And now, with the AI thing that's happening in markets and in the economy, you have a very, very serious demand for semiconductors. And the ability to produce these semiconductors is contingent on our ability to actually produce them. And so what has been needed is a very, very large amount of investment to actually meet this burgeoning demand for semiconductors. And so when we look at what has happened over the last year is we've seen massive investments, both incentivized by the government and also just by very large corporations that are very cash rich, in increasing their ability to produce semiconductors. And so what you've seen is one of the largest rises in construction for semiconductor plants that we ever seen. And so what that has done is within the broader construction complex, it's created a lot of resiliency. So usually what you would have is construction, which, residential construction is a part of construction, non-residential is also a part. Typically, residential construction and non-residential construction would begin to soften as interest rates rise. But because of these dynamics within the semiconductor industry, you've actually had massive investments into construction. And so you actually haven't seen the amount of softening that you typically would in response to higher rates. And then the second one, which is kind of also related, is you've had an automobile shortage. And so you've had a very large automobile shortage, which has actually caused automobile, both dealers and retailers, to have a shortage of automobile inventories. And those inventories just haven't been restocked. And so while you can have weaker consumer demand for automobiles, B2B demand for automobiles is still very strong because they need to rebuild inventories relative to sales. And so when you put all of these things together, right, so there are two kind of idiosyncratic drivers and then one, these two kind of structural drivers, what you basically had is an economy which is very resilient to, tightening and kind of the typical path that you expect.
Okay. So now, given that the economy was resilient, and I'll buy a lot of those arguments, and especially the one about people not understanding that the government is a net debtor, and that means the private sector is a net creditor, and that in terms of interest rates rising, that actually puts more money out into the economy. Given that the economy has been more resilient, do you feel that the Fed has a greater chance of overshooting whatever, everyone talks about R-star, but let's just say what would be a typical rate hike? Could we be experiencing Powell panicking when he's not actually able to affect the economy as much as he thinks he is?
Right. And so I think that what needs to be done, right, is that I think that the end result is going to be that we're going to have to keep rates higher than most people expect. And the reason for that is because for these kind of linkages to play out the way that they typically have, you're just going to need to have a lot of time at a higher level of interest rates for these debt service costs to make their way through the system and have a meaningful impact and tightening on economic conditions. And so I think the major takeaway, like you mentioned, I'm not really certain about what R-star is, but what we can say is that even with current tightening in place, and, so we do a lot of projections and things like that to estimate the impact of interest rates on debt service burdens and relative to income. And so even with historic rises in interest rate costs, we still won't get to a place where interest rates are high relative to nominal income for at least the next 6 months, if not a year. And so without a really bad deterioration in nominal income, you're just not going to see the typical dynamics that you would see. And so, like, when it comes to an overshoot, I can't really say what an overshoot would be. But what I think is important is that we probably just have to be in a higher rate environment for a longer period of time.
What about the idea that both the consumer through mortgages and their refis in 2020 and the corporates in general who took advantage of the liquidity that existed in 2021 and did the most refinancing that had ever been done in terms of turning over their book and issuing debt, we have a situation where the duration makes it so that they're, like, because they've locked in rates, it's actually less able to, the short-term rate doesn't matter as much. Yet eventually what's going to happen is that when these things have to be rolled or people have to move, there's going to be a huge sticker shock.
Right. And I think that's kind of like the maturity wall argument, right? So I think that does make sense. But I think that what's important is that, most corporate debt matures around 2030, right? And so I think that what you will have marginal tightening, because nobody wants to refinance all of their debt at the same time, right? You try to marginally and slowly kind of refinance your debt.
Unless it's 2020 and you can redo it all at zero, at
exactly.
1 or 2.
Exactly. And so, if you're in a high rate environment, you probably take the incremental approach as opposed to the 2020 approach, right?
Agreed. Yeah.
And so I think that is a valid argument. But the thing is that I think that tightening of conditions takes a much longer time to play out. And so I think that that's a slow process. And so what really needs to happen, in my view, to achieve adequate tightening is that you need to impact the cyclical sectors of the economy very significantly. And you need to have a tightening of financial conditions enough to actually increase savings rates. And I think when you put both of those things together, you can have a situation where you contract activity meaningfully. And we can talk about like the pluses and minuses within kind of that view. But I think that those are the things that are required to actually get you to kind of recessionary territory.
So you would almost argue that Powell's got to go back to targeting financial conditions?
I think that this cycle is relatively unique in the sense that interest rate policy, right, does have its impacts on residential investment and on all kinds of levered investment. But at the same time, we've seen that given the size of the consumer and the contributions of the consumer to GDP today, we need to have some amount of slowing in spending. And so the way to do that is twofold. Either you can hurt cyclical parts of the economy and do the usual template and get to the point where you have layoffs. That's one way to slow down spending. The other way to do it is to cause financial conditions to tighten, which is going to impact the net worth of the consumer to bring up savings rates. And you end up at roughly the same place.
Would you not agree, would you agree that what would be even better is actually increase taxes or spend less as a government?
I think it's the best thing.
Right. Yeah.
But
that's not, Powell doesn't have that option though.
Yeah, right. And that's the thing. So I think in terms of mechanically, the easiest way to deal with both inflation and to deal with, generating an economic slowdown consistent with 2% is fiscal policy. But the practicality of it is it's probably unfeasible.
Isn't it ironic that in 2008, Bernanke was begging the Congress to spend more because he couldn't affect interest rates. Interest rates couldn't actually stimulate the economy anymore. And here we have the opposite, where in essence, really, Powell should be begging them to raise taxes because his interest rate policy, the monetary policy, is more ineffective than it has been in the past.
Right, absolutely. And I think that also just speaks to, the only thing that can reverse the amount of liquidity they created and put into the system via this hybrid of monetary and fiscal policy is a contraction in monetary and fiscal policy together.
Oh, you think they need to go together? Like, you don't think that if they just increase taxes, it'd be good enough?
I think that the amount of tax, so this is very hypothetical, right? And so I think that, what you really need is what we had a little bit of in the start of 2022. which was where you had monetary policy extremely tight, expectations of monetary policy extremely tight, and you actually had the government running the first surplus in decades. And that's what actually had the most significant impact, both across corporate profits and across markets. And so I think that what you really need, if you want to deal with this very quickly and efficiently, is a combination of the two.
And I have a question for you in terms of, since we're talking about Powell and policy, one of the things that always kind of struck me as dumb is that you use quantitative easing as a policy tool to get the economy going. And yet, when it comes to quantitative tightening, in terms of slowing it down, they're like, no, that has to be put on autopilot. We can't use that as a policy tool. Don't you think that's a little kind of, having your cake and eating it too? And do you think that if the Federal Reserve had been more aggressive selling bonds first, or as they were raising rates, that maybe it would have led to a better outcome?
I think that this is bang on. Like, I think you're totally right in the sense that I don't, and I'm sure there's a lot of inner workings, and I have my guesses, right? But I'm not sure why you would make the choice to go with runoff rather than outright sales. Because by going with runoff, you've essentially handed off the impact of QT to the Treasury, right? So they determine what is going to happen to the total outstanding duration of Treasury and Fed securities. And so I think that what you're saying is totally spot on, that the most effective way was to actually go out and sell duration into the market to tighten financial conditions. To speak to my guess on the matter is that I think that they, given the fact that they had been kind of underwriting debt issuance for so long, I think that they wanted to give the Treasury the lever in terms of managing the stability of debt service costs, right? Like, for the government. Like, I think that was the only reason that makes sense to me.
Well, the other thing, I think they have some weird ideas. Like, do you remember when Powell was insistent that he couldn't raise rates because they were in the final months of the QE? They were still buying bonds, and they're like, no, we can't be doing QE and raising rates. And we all know from a plumbing perspective, of course you could. There was no reason to do it. They argue that it's like you don't want to be doing both, like sucking and blowing at the same time. And I kind of get that, but not really. And I think it ended up being a huge mistake waiting so long. But I think that they, at the end of the day, are scared to like use the QT as a policy tool, because I think that if we get a situation where the stock market starts to go down, or the bond market goes and it gets into trouble, then they'll be like, you're doing too much. And it ends up being a situation where they can be blamed. And with this way, they can just be like, no, we had it on autopilot. That's not us, and that's my gut. That's what I think. That's the reason they do that.
And it dovetails well, right? Because you want, like, the part of the Treasury's job is to maintain the stability of U.S. funding, right? Like, they're trying to maintain the stability of government funding. And so I think that if they were to, come in and say, hey, like, we're effectively in charge of the duration supply, that could have pretty negative effects on the bond market, which would impact what the Treasury needs to do. And so, yeah.
Right, that's true. Yeah, you're right. You'd have two cooks in the kitchen almost.
Exactly. And so this is the only reason that kind of makes sense to me.
Yeah, no, I can buy that. Okay, so one of the things you touched on there was liquidity. And if we kind of backtrack to the beginning of 2023, lots of people were talking about the TGA was going to go up and there was going to be this demand for liquidity. And I remember telling people, well, be careful, because we have this RRP program, and the RRP is monstrous, and the demand for liquidity with the TGA increase could be completely offset by the RRP, which it was, and then some. So I was wondering how you see those different accounts affecting markets, what your thoughts are, where you think they go from here. Is the point where we're watching the TGA and the RRP behind us, or is there more surprises in store for us?
Yeah, I think it's a very important discussion, and probably, if you wind back about a week, you had a week or two, maybe about two now, you had treasury issuance announced, right? And that was a sea change for markets. And so if you look at market pricing since, you had issuance announced, you actually had pretty significant changes in terms of the environment for equities, and bonds have had a pretty tough time. So I think it's good that we got into the liquidity thing. And so maybe just to take a step back, Kevin, I'd like to kind of frame how we think about liquidity, because we have a slightly different view, right?
Okay, let's do it.
So when we think about liquidity, we try to have a comprehensive view of liquidity. And so for us, what liquidity is liquidity is the flow of cash and cash-like assets that potentiates spending in both the real economy and financial markets. So the more liquidity you have in the system, the less risk there is. But it also means that you have more potential to take on risk, and vice versa. So when you are trying to measure liquidity, what you're really trying to measure is the riskiness of the aggregate economy balance sheet. And there are different players, and you can look at all of them differently. But this is what you're really trying to measure. And so the RRP and the TGA and reserve balances and all these things are a subset of that. And so when you're thinking about liquidity, there are really two parts. There's how much risk that currently is in the system, and there's how much risk is coming online. And so I think that what you have to think about today is that the Treasury is issuing a lot of bonds relative to recent history. And for a variety of reasons, the demand for those bonds is probably going to be weak, which means that the only way that those bonds are going to clear, and they have to be absorbed by the private sector, is that yields on those bonds are going to have to go higher. And we can obviously talk about why we think that those yields have to be high and why they're going to be poorly received, but let's just take that as a given for now. What that means is that existing bondholders are likely going to get hurt on their repricing. But what it also means is that to buy these bonds, investors are going to have to do one of two things. You're going to have to either move from cash into assets, or you're going to have to sell assets. And what we think is that it's unlikely that they're going to move from cash into assets, largely because of carry. And the only other avenue is to sell assets of similar duration. And so what you're going to have with this incoming Treasury issuance is a pressure on all assets, which has begun to manifest over the last couple of weeks. And so putting all of this together, right, what we think is that the issuance of bonds over the next few quarters is going to be an injection of risk, which, if you go back to our definition, is in effect a decline in liquidity, which will hurt assets across the board.
Now, are you saying that's because there's duration to it, or if they were selling T-bills, would you feel the same way? Okay, so what you're saying is that it's the duration of the assets they're selling that is the issue.
Right. And so you can think of it as there's an aggregate investor portfolio. And that aggregate investor portfolio, given, the fact that there is a very, very large amount of cash in the RRP to connect it to the RRP conversation, can easily absorb Treasury bill issuance. But that investor portfolio, given economic conditions and what's happening with inflation and GDP and all these things, can't as readily absorb treasury bond issuance.
Right. So if this deficit had been financed more by treasury bills, the RRP would have just gone down by that amount, and it would have had a lesser effect. So you're saying that liquidity is important in terms of the type of liquidity that you need to watch for.
Absolutely. And so, if you were to have bills issued, or even, I think that what really, really matters, like you said, is that what really matters is not only the size of issuance, but the composition of issuance. And the more they skew it towards short duration, the more liquidity enhancing or the less liquidity drain it is.
Right. And this kind of dovetails into what David Zervos, I think one of his arguments about why the economy has been stronger than people expect is because the Fed has owned more of the duration than in a typical environment. So therefore, as the rates went up and the price of bonds went down, the actual losses were held at the Fed as opposed to into the private sector.
Right. And so, you can think of also the Fed's losses as essentially being transmitted to the private sector, right?
Right. Exactly.
So I think the main thing, right? And so this dovetails very nicely into the idea of why is the duration not well accepted? And so I think that what that boils down to is who are the buyers and sellers of this duration? And so when we look at the current environment, like I think that anybody looking back can say that it's been a pretty tough year for bonds.
Yeah.
And so, that in itself, as you know, is kind of a self-reinforcing phenomena, right? Like people are a little bit more
for sure,
things like that. But at the same time, the shape of the curve really matters, because a lot of players are willing to either implicitly or explicitly get long bonds or get long bonds by shorting cash, right? So you can lever up and get long bonds.
Yeah. Except when the yield curve's inverted, at which point it's negative.
It's just not a comfortable position. And then you can think about, for us, right? The Fed was the marginal buyer of bonds. But now that they aren't, the entity that we think is going to be the eventual marginal buyer of bonds is going to be the commercial banks. And even though they might not be levering up explicitly, they effectively are, because they have to pay short-term interest rates on their deposits.
Right. So they're not going to be buyers yet.
Exactly. And so when you look at that kind of perspective and, NGDP printing at, above 4 handles, above five handles, when you put all of these things together, it's very hard to find buyers of this duration. And so,
but you know what's kind of, I don't mean to interrupt, but it's kind of interesting because this is a great kind of comment, and I'm 100% in your camp, and I've been a bond bear for a long time. But I've always kind of been amazed that it was only 3 months ago that everyone was saying, recession, bro, you don't understand. And they were all saying how you were going to get, buy TLT, wear gold chains or whatever it is, diamonds or whatever their lines are. And it was a very popular trade. And I was always kind of perplexed about it because, as you say, it carried poorly. There was a million reasons not to like it, yet people seem to love it. And I almost wonder, was the real mistake for the curve to be as inverted as it was? Like everyone's getting all excited about the bond market going down. I'm like, this isn't anything yet. The curve's still inverted. It's like, this isn't that big a deal. And yet they're kind of losing their mind. And I'm like, so I guess my question to you is, do you think the bond market was just plain wrong 3 months ago?
I think that, if you look at so I think that there are 2 parts to it, right? So if we wind back to the conversation that we were having about growth, right? What most of the street, right, use to forecast growth are these cyclical indicators. And so those cyclical indicators are things like manufacturing, things like ISM, things that tend to be very, very manufacturing centric. And those things have turned down. Those things turned down last year and got even worse. The yield curve inverted and all of these things. But for the reasons that we explained at the start of this conversation, Kevin, you just didn't have the material slowing that those indicators would have told you. And I think that was a very big part of what was baked into bond market expectations. I think the second component is that there is some degree, right? And this is less substantiated by proof and more of a theory of mine, but bear with me. I think there is a combination of mean reversion in markets and also a mechanical bid for duration over time, especially in an environment where NGDP is high. So I think the mean reversion thing is pretty clear in the sense that we haven't in the last decade or so experienced interest rates like this. And so if you look at every turn, every time economic data comes out marginally weak, you've had a tendency of both short-term interest rate markets and, duration to begin to price conditions that are more consistent with a recession. And that pricing has just got priced out again and again and again, which has made bonds what they are this year. And on the mechanical side, I think that what you have to, also think about is the fact that there are a lot of mechanical buyers, in the sense that, pension funds and things like that receive their inflows from nominal GDP. And nominal GDP skyrocketed last year. And so part of that is probably also, underwriting a little bit of the duration bit. And so I think when you put all of these things together, right, the kind of misleading leading indicators, the mean reversion tendency of markets to price what has happened in recent past, and also some amount of this mechanical bid, I think that's really what has created the bond dynamics that we've seen over the last 6 months.
So I think it's a secular change in the bond market. We had a bull market for 40 years, and it's a little bit of a recency bias to your point about the fact that people keep remembering it. But I do have a funny story to tell you. I wrote a piece for Bloomberg in January of 2022, and it was titled "The Bond Market Refuses to Accept Economic Reality." And I was somewhat bearish on bonds. And you should have seen the folks writing me, telling me how, there's the amount of people that are being buried trying to bet against the bond market, and telling me, how the bond market is always right. And yet, if you think back in 2022, what did they expect? Like rates to go to 2? Like, I can't remember. It was very low. Like, they completely got it wrong. So to your point, the bond market can be wrong for a long, long time. And we shouldn't just take those prices as meaning that it's going to be correct.
Totally. And I think that, like looking ahead from here, right? The question is, even if the bond market is right, what are you going to make? Because if you look at short-term interest rate markets today, until today, they were pricing about 5 cuts over the next 18 months.
I know. So you have to be so right. And I think people don't, but not enough people understand that you're not trading against the 5, you're trading against the baked in 4 in a year's time or whatever it is. And that is an element that people miss. And they also miss that it was baked into TLT or the 10-year, the 20-year, the 30-year. All of that curve was baked in there as well.
That pricing that's in short-term interest rate markets is priced through the entire curve. And so right. For you to make a good trade, you need to have 8 cuts realized, 6 cuts realized relative to what's already priced, which is 4. And, the question also, I think, is that, hey, do I know what's going to happen 18 months from now? We're systematic investors. We have a whole bunch, we have a lot of data, a lot of models, a lot of analysis. And I can tell you, nobody knows what's going to happen 18 months from now. But the bond market has 100% certainty of 4 to 5 cuts over the next 18 months. And I don't think that's right. And I think that...
Well, sorry to interrupt, but the other thing that I think that people miss about the bond market with the 4 to 5 cuts is that the distribution of the future policy is not as even as the market looks like, because it's either there's a good chance that they're going to cut nothing, or there is going to be some sort of market event and they'll cut 400. Right. And that's the part that people miss, because they'll look at it and they'll be like this nice step down. And you have to kind of ask yourself what the distribution of those returns are. Okay, so let's talk a little bit about your models, what you guys are looking at, and let's talk about inflation. What do you expect it to look like in the coming months, quarters, years?
So we don't think we're going to end. We don't think we're going to end this year under 2. We don't think and I think that's not a very out there kind of view. I think that, when we look at what is likely to happen over the next 12 months, we think that shelter is likely to decline. So the way we group inflation is basically into 4 large categories. There's food, energy, housing, and transport. And so what we see in terms of happening over the next 12 months is that housing is going to be the biggest driver of disinflation. And so there has been a period of time where housing in itself alone could have driven, kept inflation above 2%. That time is behind us. And so housing is likely to be a much lower contributor over the next 12 months. Where we think there is likely to be resilience in inflation is in the transportation component. And so I think that what's important here is to realize that transportation has a few different parts, right? What is really popular today is to kind of look at a data series like Manheim, right, which is the used car price index, to forecast transport inflation. And that's been really successful over the pandemic. The reason that that's been really successful is because used car prices experienced the most significant volatility they've experienced in decades during the pandemic and post-pandemic period, because essentially you had new car supply go to zero. And so when you look at the transport series, what has been typical in history is for new cars and used cars to have about a equal kind of contribution. And so unless we expect to keep having used cars deflate at the rate at which they're deflating, which is quite historic, it's unlikely that we can continue to see as much deflation from transport in the future. Now, when you're thinking about car demand, right, I think there are two perspectives to keep in mind. If you are in the recessionary camp and you think that, end consumer demand is going to be weak because of tightening, because of potential unemployment and things like that, new car and used car demand will probably be marginally weaker. But I think the main thing to think about is that automobile inventories are massively depleted for retailers and wholesalers. And so even in the environment that the economy is slowing, these retailers and wholesalers still have to increase their automobile inventory, which is going to be a net support to new car demand and prices. And so even if you have a balanced perspective of, okay, new cars are kind of okay, used cars are kind of bad, that still doesn't keep you at the same pace of declines for transportation. And so I think that when you're thinking about inflation, what you really have to worry about is, are we going to be at 2.5% over the next 12 months, or are we going to be 3.5%? And reality somewhere, probably between 275 and 325.
Which will be a lot more than what the market has priced in. Like if you go look at the curve, they think that next year is going to end, or next year, it's going to end at like a year's time. It'll be like 2.25.
Right. And I think that's a meaningful thing. And so I think, you're talking about break evens, right?
Well, break evens or inflation swaps, which are even better than break evens, because break evens generally trade cheap versus inflation swaps. So if you go look at what the inflation swaps are pricing in the curve, they have it. Yes, they have it going up in the next month or two, but then by the end of the year, they have it, or by year's time, they have it at 2.25 or almost 2.
And so, I think that's kind of the nitty gritty perspective. So I think you're right that that's the nitty gritty perspective. And then the second perspective, right, is the macroeconomic perspective. And so what we do is we monitor a bunch of different indicators to essentially figure out, are we in or around inflation equilibrium? And so what those indicators are basically just a bunch of indicators that tell us, are we running too hot or too cold? And so there are things like capacity utilization, unemployment rates, et cetera, with sub-detail, et cetera. What we think is the most inflationary dynamic today is the level of nominal spending relative to net interest rate costs for the private sector. And that number remains still consistent with numbers that we saw in the 70s. And so you've had some amount of, capacity utilization declines. Unemployment is still extremely low. But when we look at the net interest rate cost relative to nominal income in the private sector, that number is just too elevated, making debt service payments pretty easy. And so you don't have the same amount of profit squeeze that you used to, which elicits the labor market impact, which eventually impacts inflation. And so what we think is that until that nominal spending relative to debt service costs is contained, we're in a macroeconomic inflationary environment. And that was the same dynamic that we saw in the 70s.
Got it. All right. So when you look at what the market is pricing in and expecting, what do you think will be the biggest surprise for them over the kind of coming year? Like what do you think the market's getting the most wrong?
Right. And I think the two things, right? The two things that don't make too much sense to me and they're related, is, as we talked about, the discount rate cuts that are priced in the markets right now.
Okay.
And so if you look at current conditions, so what we do is we stress test our forecasts, right? And so, we have a GDP nowcast and we model out the subcomponents and we forecast those components. And what we do is we stress test to see, hey, if we make these parts really bad and these parts really good, where can we get to in terms of growth? And what that process has yielded for us is that even if we see like typical recessionary kind of initial recessionary activity, slowdowns in residential investment, declines in equipment investment, which is just synonymous with declines in industrial production, it's still going to be pretty hard to get to a place when nominal spending is very meaningfully impacted, which basically just means that you have a resilient economy, even if it's a decelerating economy. And I think the very important thing to realize is that a decelerating economy is not the same as a contracting economy, particularly for the Fed. And so you could have manufacturing start to tank, you could have residential spending look pretty weak, but you could still have consumer spending look pretty decent. And so as a result, the Fed is going to have to wait until conditions actually get bad and inflation actually deteriorates meaningfully below their target. And so when we look at that picture, what's priced into short-term interest rate markets looks very incongruent with economic realities. And I think it's because of the dynamics that we discussed. On top of that, given, kind of the duration supply dynamics and things like that, we think the shape of the curve is a little too inverted relative to where it needs to be. And so what we think is the major thing that needs to happen is that we need to have lower bond prices. We have equity views, a little less conviction on the equity views, but the major thing I think is that bond prices need to be lower.
How much lower are you thinking?
We're quantitative guys. I don't really have a forecast for you.
Okay, you just think it's lower. But do you think the curve normalizes?
So I think that for the Fed to get what it wants, that needs to happen. So if you want a number, then that's got to be above 5. It's got to be above 5.25. Right?
And you know what the kind of paradox about that comment is that the curve needs to go flatter, less inverted, for the Fed to achieve the recession that they want. That's what you said. I'm not saying you're wrong. I'm just saying it's kind of strange because usually it's the other way around. Usually they need to invert the curve to get it, and yet in this case, it's actually the long end that they need to move, not the short end.
Right, and I think that what's also important is that every single recession actually starts when the curve starts to steepen, not at the actual inversion. And so there's a mixed track record in terms of whether that inversion is because you're cutting short-term interest rates or because the long end is selling off. But I think that what we need is you need a tightening of financial conditions, right? And that tightening of financial conditions will come with curves steepening, which will be synonymous with a whole bunch of things happening in the real economy. And so I think that tracking financial conditions is a very important barometer of the symptoms. But if you're really looking for what is happening, what is going to cause a recession, it is going to be a slowdown in investment in the economy, real residential and non-residential investment in the economy. But those things just happen to be synonymous generally. And so, like we talked about earlier, right? You need to both hurt consumption and investment to get to a meaningful contraction in activity. To impact consumption, you have to have a net worth effect, which is going to come from steeper curves and stocks selling off. Those things tend to be synonymous with weaker investment in the broader economy in terms of residential and non-residential investment. So I think that's the package you're looking at. And so, steeper curves is kind of part of that package.
So let's end with stocks. And I'll just read what you wrote to me earlier. You said, we think stocks outperform bonds, but we don't like them on a standalone basis. We think policy tightening will hurt all assets, but policy tightening will occur because of resilient nominal GDP. Until serious cracks emerge, we think stocks look better than bonds, though neither looks good. So tell us about, are you just kind of doing a Chuck Prince and trying to dance while the music's still going on stocks, or?
I think that this has been a very interesting trade. We published about this like a few weeks ago, and I think that obviously stocks versus bonds has been the trade of the year. And so, given our outlook on bonds, right? So I think it's clear that we think that bonds are probably going to soften. What we think is really important to realize is that all of the drivers that are going to hurt bonds, and the two major ones, which is the pricing out of these cuts and the steepening of the curve due to this duration supply, hurt both stocks and bonds. But the reason that these things are happening is going to be because of elevated or resilient nominal GDP. And so the pricing out of discount rate cuts is obvious because you're just going to have a bunch of economic data that probably surprises or stays stable, which is not consistent with recession, which means that it's a benefit for stocks, right? On the duration supply component, what I think is really important is that the duration supply is used to fund a deficit. And that deficit today has largely been going to actually paying out interest expense for the treasury and interest benefits to the private sector. And so what duration supply does is it might impact liquidity, but it's also marginally supporting nominal GDP. And so when we look at the drivers of stocks and bonds, the impacts coming from this liquidity tightening that we talked about is going to hurt both of them. But it's also going to be because nominal GDP, revenues, and earnings are more resilient. And so if you're looking for something that I think that works in most scenarios, except for a very serious recessionary scenario, I think that stocks relative to bonds makes sense.
Got it. All right. So it's been a fascinating discussion. We're not going to let you leave without a question. And what we're going to do is we'll listen to what Jason Shapiro, our previous guest, left for you on the kind of pass it along question. So here we go. Here's Jason.
So if it's an investment person, or even not, but I always ask people, what are you doing that's different to what other people are doing?
All right. So can you answer Jason's question?
Yeah, for sure. I think what we do is we have a few things that are pretty different from people, right? We live in a world of systematic macro, which is like the hardest thing to systematize. So what we try to do is, all of the things that we discussed, we try to take our logic and we try to systematize that logic and we try to test it over time and create durable strategies that, we think are going to perform across time and across geographies. And so that's the thing that we think that we do really differently from most people. There's a lot of nuance into what goes into making it particularly different, but in a nutshell, that's what we really try to do. We try to have a very, very good understanding of how the economy works, what's driving the economy, and then using that understanding to actually trade markets.
All right. And have you got a question for the next guest?
Yeah, I think something topical should be fun. So I think I was going to go with, if you're an investment professional, is AI going to change your investment process? Has it already? If so, how?
That's great. That's a terrific one. All right. Aahan, it's been great chatting with you. Why don't you tell people where they can find more about Prometheus?
So you can find us at Prometheus-research.com. That's our website. You can also find us on Twitter. We're pretty active there. It's at Prometheus Macro. And yeah.
That's it. Well, that's great. Well, thank you for your time. It was a pleasure getting to know you, and I've really enjoyed this chat.
Hey, likewise.